everyone. Free Kennedy, and welcome to Market Academy. Well, what I've decided to do this week and actually in the next few weeks is I want to do more of a focus on the Elliott wave principle. So what we're going to be doing, again, this week, we're going to be focused on impulse waves. Next week, we're going to focus on diagonals. And I think in doing so over the next, say, 3 to 4 weeks, as we go through this, say, seminar, you could almost say, it's going to be proportioned, 3 lessons a week. It will give you a better understanding of the wave principle. And I'll also, too, share with you some of my insights along the way to hopefully help make you a better Elliott wave practitioner. So let's go ahead and get started. Today, we're going to be focusing on impulse waves, but just to go ahead and kind of tee up today's topic and also the following topics, let's look at the 5 core patterns. Now, again, this slide is nothing new. I show this slide quite frequently. And the reason I do so is because these 5 patterns represent the foundation upon which the Elliott wave principle is built. So what exactly is the wave principle? Well, the wave principle is nothing more than a form of technical analysis based on pattern recognition and crowd psychology. The patterns you see in front of us were developed and identified, more importantly, codified by Ralph Nelson Elliott in the 1930s. And essentially what he discovered was that whenever you get a group of people together, they behave in very predictable ways. And if you look at the financial markets, the way prices unfold as you get that crowd together and you have the buyers and the sellers, their behavior is represented by these individual patterns. Now, again, moving forward, we will kind of delve a little bit deeper into each one of these patterns because each one of these patterns has their own unique set of rules and guidelines which governs their development, and also, too, they have their own complexities and, say, variations. So let's go ahead and get started. One thing that's probably important to remember, too, one of the ways we classify price action as Elliottians is to recognize there are 2 primary types of market action. One we call motive waves, and that would be, of course, the impulse wave here to the left and the ending diagonal to the right. And then we have our corrections, or corrective wave patterns, the zigzag, the flat, and the triangle. And yes, there are variations and complexities, but we will get to that, soon enough. Whenever we begin talking about the flat pattern, we'll talk about some of its variations, for example, the expanded flat and then the running flat and so on. But today and this week, I specifically want to focus on impulse waves. So that's what we're going to be studying in today's lesson. So let's go ahead and get started. And first, what I'd like to discuss would be just some of the key, say, characteristics and guidelines, but also, too, share with you some of the Fibonacci proportions. These are idealized Fibonacci proportions, specifically related to impulse wave development. So this is an impulse wave. It's a 5-wave move. We use numbers to identify motive waves. So 1, 2, 3, 4, and 5. Now, when it comes to the corrections, we'll use letters to identify the substructure of those patterns. Now, some of the cardinal rules or the big rules that we never want to break would be wave 2 never retraces more than 100% of wave 1. Wave 3 can never, ever be the shortest impulse wave of waves 1, 3, and or 5. Now, it doesn't have to be the longest, but it can never be the shortest. And then you have wave 4. Wave 4 may never end in the price territory of wave 1. And then, of course, we have our 5th wave move up. Now, still, after 30 plus years, I will say this, without question. I'm more of a believer now in the Elliott wave principle than I ever have, and I've been counting waves for over 30 years. And to really learn the intricacies, the rules, the guidelines, the nuances, there is no better book out there, in my opinion, than the Elliott wave principle written by A.J. Frost and Robert Prechter. As many of you know, I've spent 30 years at Elliott Wave International. It was a great learning experience. But the book that Bob wrote, and he's written several books actually on the wave principle, but his cornerstone book, his initial book, The Wave Principle, again written by A.J. Frost and Robert Prechter, is a must-have. So if you are interested in learning more about the Elliott Wave Principle, that book is an essential reading. And if you ultimately want to learn how to incorporate the wave principle in your trading, then my book, The Visual Guide to Elliott Wave Trading, written by Wayne Gorman and myself, is, say, an extension of Bob's original work. Where in Bob's work, Bob's book, he discusses, again, the rules, the guidelines, the nuances, the foundation of the Elliott Wave Principle. My book is geared more towards, say, the end game. It's more practical. It's more geared towards, say, application, applying the wave principle to identify high confidence trade setups and how to utilize the wave principle and basically trading, entry technique, exit technique, and so on. So let's go back to the impulse wave. Now, as you know, the Fibonacci sequence is an essential ingredient to counting waves. And the reason we believe this as Elliottians is because when Ralph Nelson Elliott wrote, I believe in one of his books, one of his works, Nature's Law, he stated emphatically that the Fibonacci sequence was indeed the mathematical basis of the wave principle. So as Elliottians, we're always doing calculations in order to attempt to identify either retracements and or multiples. So this is an idealized impulse wave. And once you have your 5-wave move up, you have your 3-wave decline for wave 2. The most common Fibonacci retracement for wave 2 is a 618 multiple of wave 1. When it comes to wave 3, we typically look for a 1.618 multiple. If wave 3 is exuberant, and it most often is in the equity markets, then you'll be looking for something perhaps larger, 2.0 or even 2.618 multiples. Once wave 3 is complete, we see a 4th wave move, and the most common Fibonacci retracement for a 4th wave is a 382 multiple of wave 3. And then we go on to wave 5. Well, one of the guidelines which governs the development of impulse waves is the guideline of wave equality, which simply states that in a 5-wave move, 2 waves tend toward equality and 1 wave will be extended. So, and again, in the equity market or the indices, whenever you have an impulse wave, wave 3 is typically going to be your longest wave. And when that occurs, we tend to look for wave 1 and wave 5 to pretty much be proportional, be equal in length. Now, one thing that I always, consciously want to reinforce when it comes to Fibonacci multiples and Fibonacci retracements is that these are guidelines. Okay, these are not absolutes. These are not rules. And the reason I say that is because on more than one occasion, I have seen wave 2 only come back to a 50% retracement of wave 1. Sometimes I've seen wave 2 come back to a 786 multiple of wave 1. Sometimes I've seen wave 3 actually exceed a 2.618 multiple, and sometimes, albeit rare, I'll actually see wave 3 fall short of a 1.618 multiple. And the same thing with wave 4 and wave 5. Remember, these are idealized. Okay, say in a perfect world, if we're going to be, say, looking at the wave principle and substructure of impulse waves in a quote unquote academic environment, this is what we would consider the idealized wave structure and also too idealized Fibonacci proportion. So now let's begin to take a look and examine some of the, say, complexities and variations of impulse wave development. And I've sketched those out in the next slide. Now, what you have here are impulse waves, but you have 3 different types of impulse waves. And the way we identify them are simply based on where the extended wave actually occurs. Now, over here to the far left, you have your idealized impulse wave. Waves 1, 2, big 3, pull back in 4, and then up in 5. This is what you're going to encounter, say 60, 80% of the time. This is what we tend to look for. This is, my go-to whenever I'm working impulse wave development. Now, in the middle diagram, you'll notice that wave 1 is the longest wave. Then you have your wave 2 pullback, your wave 3. Notice again, the rules and guidelines are adhered to. Wave 2 does not terminate below the origin point of wave 1. Wave 4 does not end in the price territory of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. And then you have your push higher in wave 5. So in this impulsive wave, wave 1 is the extended wave, and then waves 3 and 5 tend toward equality, or they're proportional to a certain degree. This type of structure is rare, okay, but when I do encounter it, again, this is more anecdotal and more from experience than anything else, but when I do encounter this type of impulse wave, it's typically in the wave 3 position of a larger impulsive structure. So the place I would typically see this kind of advance would be in the wave 3 portion of, say, a 5-wave move in an index or an individual stock. Now, over on the far right, we have another type of impulse wave. Notice again, waves 1 and 3 tend toward equality, but in this instance, wave 5 is the extended wave. Now, this tends to occur most frequently, not in the indices or equity markets, but actually in commodities, because this move up is really kind of driven by fear, and it's sometimes referred to as like a buying climax. There are several examples of buying climaxes in many of the commodities I follow. For example, oats or wheat, or say recently in the meat complex with live cattle and feeder cattle. So now, just because this is an extended fifth wave, and just because I say it happens frequently or most often in the commodity markets, does not mean it cannot happen in an index or an individual stock. But if I were to see something like this in, say, XYZ stock, I would be more inclined to think, okay, hey, that's 1, 2, 1, 2, and then this is wave 3 of 3. But if I'm looking at a commodity market, then I would say, okay, this is probably an extended fifth wave. But these are some of the variations of the core impulse wave development, or the core idealized impulsive structure we work with as Elioticians. Now, also, too, it's important to remember that the wave principle is fractal. Okay, a fractal, for those of you who may not be familiar with the term, is simply a self-similar pattern independent of scale. So one example that we always use to kind of drive home the point is that if you're looking at, say, 5 or 10 miles of coastline from a plane, it looks very similar to maybe a 100-mile stretch of coastline from a plane, or maybe higher up in orbit. Well, the reason we say that is because these patterns that we work with, these 5 core patterns that we work with as Elioticians, they actually form larger and smaller versions of themselves. So, for example, this 5-wave move, we would actually use the notation 5, 3, 5, 3, 5. And that simply means that wave 1, of course, will subdivide into 5 waves. Wave 2 will subdivide into 3 waves. Wave 3 will subdivide into 5 waves, and so on for 4, and so on for 5. And then this 5-wave move is actually going to be a building block of a larger pattern. Perhaps wave 1 of a larger impulsive structure, or perhaps wave A of a zigzag, okay? Because the first move of a zigzag, wave A of a zigzag, subdivides into 5 waves, subdivides into an impulsive structure. Okay, so now let's move on and take a look at, say, another complexity or a variation to the impulse wave, and that's going to be the truncation, the idea of a truncation and or a failed wave. What exactly is a truncation or a failed wave? Well, a truncation or a failed wave occurs whenever a wave that should make a new price extreme is unable to do so. So, for example, as we well know, wave 5 should terminate beyond the extreme of wave 3. On occasion, rarely, okay, I probably, during a given year, I might count maybe 3 or 5 truncations. But remember, I'm looking at 50 markets, pretty much continuously on a week-to-week basis, and the amount of charts I look at is pretty staggering. So when I say that, in a given year, considering all the price charts I look at, I encounter maybe 3 to 5 truncations. This is a very rare event. Does it occur? Yes, it does, but it's not the norm. Okay. So I encourage you to be very judicious whenever you're identifying substructure in your price charts or in your own wave counting, and to, even though the truncation does allow you to pretty much identify any extreme as a truncation, be judicious in that process. Don't be in a hurry to label every extreme or every failed new extreme as a truncation, because that's not necessarily true. It's not going to be true. Okay. Now, another thing about the truncated wave idea that is very, very important. Whenever you have a truncation, as I've diagrammed here, it typically leads to a very, very sharp reversal in price in the opposing direction, something like that. And the reason why is because a truncation basically implies that there's hidden or underlying selling in a particular market, which is why the fifth wave move up is unable to make the new extreme beyond the wave three peak, is because there's a massive amount of selling going on in this market, which is unseen. That's why wave five is unable to make a new high above the wave three extreme. And that's why the initial move down is often quite decisive. So on those rare occasions where you do indeed encounter a legitimate, true truncated wave, pay very, very close attention, because the subsequent move is indeed going to be quite volatile. Now, it's easy to basically understand the concept of impulse wave development. It's a core pattern. It's one we work with all the time as Ellioticians. But I remember my own personal learning curve when I first started learning about the wave principle back in the early 1990s. I had no problem looking at the line diagrams in the book, again, The Wave Principle by A.J. Frost and Robert Prechter, and I could totally understand these line diagrams that, Bob was offering, and again, which is based on R.N. Elliott's original work. It was like not a challenge. My challenge came from when I had to transition from looking at little line diagrams in the book to actually looking at real world, real markets, real price charts, specifically open, high, low, close price charts. So I want to show the next two markets here. These are, I think, new maybe, but I just wanted to simply show you some good examples, in my opinion, on what an impulse wave looks like. Okay, now notice here, I'm starting my wave count at the June low of 2022. This is Biogen, ticker symbol BIIB. And notice I'm not actually beginning the count from the actually orthodox low here at 187.20. And that's because I think this is a small truncation. Notice the big move to the upside following the truncation, following that apparent double bottom. Because I think this move up, this initial move up, if you look at, say, a more smaller term time frame, you'll see the substructure of an impulse wave more clearly than you do so on the daily chart level. By the way, this is a 2-day chart. So we have the initial wave one advance, and then you have the ABC decline for wave two, and then another 1-2. And remember some of our lessons on price gap and price gap analysis, specifically the 4 types of price gaps: the common gap, the breakaway gap, the acceleration gap, and then the exhaustion gap. Remember what we've talked about in the past as far as acceleration gaps. An acceleration gap occurs typically in wave 3 and almost always in wave 3 of 3. Well, here's an example of an acceleration gap in wave 3 of 3. And then following that, you have wave 4 of 3, and then you push higher in wave 3. So waves 1, 2, 3. Following wave 3, we have a 3-wave decline, again, contained within parallel lines. We'll be talking about that more depthly whenever we get into the lessons on corrective wave patterns. And then your final 5th wave move higher, where you have waves 1, 2, 3, 4, and 5. So notice wave 1 subdivides into 5 waves. Notice wave 3 subdivides into 5 waves. Notice wave 5 subdivides into 5 waves. Notice that wave 3 is indeed the longest impulse wave. So this advance from low to high, beginning again back in June of 2022 here, notice how idealized it does indeed look to what we've talked about here. Okay, so this is a good example of an impulse wave. Now, with that in mind, let's also take a look at some of the Fibonacci relationships we see within this move. Now, remember earlier when I said, hey, the Fibonacci retracements and multiples that we typically look for in idealized wave structure, that those are just guidelines and not rules? Well, here's why I say that. Here's the 618 retracement of wave two. Notice we fell below that. We actually went down and kind of played around with the 786 retracement. But again, just a rule of thumb, wave two, whenever wave one is complete, we're going to be looking for a wave two pullback that goes back to at or near the 618 retracement of wave one. And then we have our wave three advance. Okay, now typically we look for wave three to go to a 1.618 multiple of wave one. Well, when you're working a 1, 2, 1, 2, then I begin to look for those higher multiples. For example, 2 or even 2.618. So here's our 2.618 multiple. And notice even in this instance, prices moved beyond that level. But remember, we can also utilize Fibonacci multiples within wave three to identify a target. For example, if we use the totality of waves 1 through 3 to identify an objective for wave 5 of 3, well, right there you can see where wave 5 of 3 equals a 0.618 multiple of waves 1 through 3 of 3. So that gave you a nice objective of right 305.8. Okay, and then whenever a 5-wave move is complete, according to the guideline of depth of corrective waves, you see a retracement occur that pushes prices back into the span of travel of the prior 4th wave, most often ending near its terminus. Well, the terminus of wave 4 of 3 is right here at 250.3. Notice how close we came to that level. And from the prior slide on Fibonacci retracements for 4th waves, we know that the most common Fibonacci retracement for a 4th wave is a 382 multiple of wave A. Well, notice we came down to the 382 in wave A of 4, and then we got a little bit closer to that 50% retracement. So remember, the Fibonacci multiples, as far as retracements and multiples, as far as corrections, your 2 and 4, and your multiples for wave 3 and 5, these are, again, are simply offered as guidelines. These are not absolutes, okay? This is why, as Ellioticians, we do extensive calculations, okay? And then once we have waves 1, 2, 3, and then our ABC decline for wave 4. So what does this tell us about the market whenever we see prices exceed that wave 3 extreme? Well, at this point, we know one thing. We basically know that wave 5 is a terminal wave. It's the final move of the larger impulsive structure. So at this point, once we start making new price highs above the extreme of wave 3 at 311.9, we know that the risk is to the downside. And our first target to the downside would be the prior 4th wave extreme. That comes into play at 254.8. And notice how this decline actually fell below that and even pressed lower. It looks like we even fell a little bit below the 618 retracement of the entire structure. And as you can see, that's just exactly what has occurred here. But this is why the wave principle is valuable, is because once you can identify these patterns and do so correctly, they're very, very useful in identifying where the risk is in the market. Is the risk or is the opportunity to the buy side, or is the risk or is the opportunity to the sell side? Now, because this is a 5-wave advance, it tells us that the larger trend is up. So I would suspect this is probably 5 waves up for wave 1, and that this pullback here is a 2 because of the substructure, most likely a complex correction. Now let's look at a 5-wave move in a bear market or a downtrending market. Now here we have Campbell Soup Company, and what we have here off the high that occurred back in December of 2022, we have an impulsive decline for wave 1, then we have our counter trend move. Now, the reason I'm confident in identifying the low here at 37.94 as wave 3 is because we did fall below the lower boundary line of a base channel. Now, base channel is a term that I basically is part of my trend line algorithm that I call the Kennedy channeling technique. And I will be doing videos and I will be doing lessons on the Kennedy channeling technique. But going back to this slide here, one of the core principle, the keystone idea behind the Kennedy channeling technique is that counter trend price action tends to be contained by parallel lines, as you can clearly see on this 4th wave pullback. So by definition, if you have a price move which is not contained within parallel lines, then that is indicative or confirmation that you're working an impulsive structure. A lot of times when it comes to the wave principle, identifying, just being able to start off on the right foot and identify something as a motive wave or a corrective wave is basically, ultimately will determine if you're on the right side of the market or not. So we have our one down, two up, and then we have our wave three sell-off. Okay, what's the most common Fibonacci retracement for a fourth wave? Well, it's the 382 retracement of wave three. So I'm going to be looking for this current advance up from 37.94 to get back into the, say, the 44.85 handle. And then also too, we have our, say, periods of congestion, which represent very small fourth wave moves. So I think a very likely objective for this fourth wave move is going to be somewhat similar to what we actually saw in Biogen, ticker symbol BIIB, where we actually see our fourth wave move most likely push up into this range right here, somewhere between the 382 retracement of wave three and the 50% retracement of wave three. And then once that move up occurs, probably culminating first week in January, then we're going to be looking for the culmination of this fourth wave move. And again, this is where the wave principle becomes valuable, not just to the analyst and trader, but more importantly for the trade. So simply put, essentially, once wave four is complete, and again, I think wave four will be complete most likely the first week in January, then we'll be looking for this final fifth wave decline to the downside, somewhere to the tune of about, say, 36 or 34. Well, that concludes today's lesson on impulse waves. Now, again, what I plan to do moving forward over the next few weeks, I think for the remainder of this week, we will continue to do nothing but focus on impulse waves. But in the weeks to come, next we'll look at diagonals, and then we'll spend some time with zigzags, of flats, and triangles. And hopefully these more in-depth lessons, specifically on each one of these individualized LE wave formations, it will give you a greater degree of, say, confidence in your own LE wave labeling. Well, that's about it for me for today. As always, thank you very, very much, and I'll see you tomorrow.